Welcome everyone to this milestone lesson in the beginner series. You've come a long way. You've learned about currency pairs, pips, lots, and risk management. You've practiced on your demo account. You understand how to read charts. Now it's time for the most exciting step, learning your first complete trading strategy. Let me be clear about what a trading strategy really is. It's not just buy here, sell there. A complete strategy is a system that answers 6 critical questions. First, what to trade. Which currency pairs or instruments? Second, when to enter. Your specific entry conditions. Third, where to place your stop loss. Your risk control. Fourth, where to take profit. Your target. Fifth, how much to trade. Your position size based on risk. And sixth, when to exit. If the trade doesn't work as planned. By the end of this lesson, you'll have a complete, repeatable strategy that you can start using on your demo account immediately. This is the moment everything comes together. Today, we're learning the moving average pullback strategy. And let me tell you why this is perfect for beginners. It's simple. We only use 2 indicators: a moving average and candlestick patterns. No complex oscillators, no confusing signals. It's objective. The rules are clear. There's no maybe or it looks like. Either the conditions are met or they aren't. It's repeatable. This strategy works on any time frame and any currency pair. Once you learn it, you can apply it anywhere. It's designed to be profitable. We target a 1-to-2 risk-reward ratio, which means even with a 40% win rate, you can be profitable over time. Let me show you how this works on the chart. Reference Figure 1. Here you can see the basic structure. In an uptrend, we look for price to pull back to the moving average, then we look for a bullish confirmation candle, and we enter. Simple but powerful. The first step is the most important, identifying the trend. And we do this using the 50-period simple moving average. Let me show you how to add it to your chart. Reference Figure 2. In MetaTrader 4, you go to Insert Indicators Trend Moving Average. Set the period to 50, the MA method to simple, apply to close price, and set the color to something visible like blue or yellow. Click OK, and you'll see the 50 SMA appear on your chart. Here's the golden rule, and I want you to remember this forever. If price is above the 50 SMA, we are in an uptrend. We can only take buy trades. If price is below the 50 SMA, we are in a downtrend. We can only take sell trades. That's it. Simple, right? But this one rule will save you from countless losing trades. Reference Figure 3. Look at this chart. When price is above the SMA, it's a clear uptrend. When price is below, it's a downtrend. And when price is chopping around the SMA, that's a ranging market. We don't trade. Never trade against the trend. This is the most important rule in all of trading. Once we've identified the trend, we don't just chase price. We wait for a pullback. What is a pullback? It's a temporary move against the trend. In an uptrend, price pulls back down toward the 50 SMA. Think of it like price taking a breath before continuing higher. In a downtrend, price rallies up toward the 50 SMA. It's a temporary pause before continuing lower. Why the 50 SMA? The 50 SMA is widely watched by institutional traders. It acts like a magnet. Price is attracted to it during pullbacks. In strongly trending markets, price often bounces off this level like a ball bouncing off the floor. Reference Figure 4. Here's an uptrend. Price moves up, pulls back to the SMA, bounces, and continues higher. This is exactly what we're looking for. Reference Figure 5. Look at all these examples, multiple pullbacks to the SMA, each one offering an opportunity to enter in the direction of the trend. The key is patience. Don't chase price. Wait for the pullback to the SMA. A pullback to the 50 SMA is not enough to enter a trade. This is where many beginners make mistakes. They see price touch the SMA and they jump in immediately. But here's the truth. Price often slices right through the SMA without reversing. That's why we need confirmation. We need a candlestick pattern to show us that the pullback is ending and the trend is resuming. In an uptrend, we look for bullish confirmation patterns. Reference Figure 6. A bullish engulfing pattern. A green candle that completely engulfs the previous red candle. This shows buyers are taking control. A hammer. A candle with a small body and a long lower wick. This shows sellers pushed price down, but buyers pushed it right back up. Rejection. A piercing pattern. A green candle that closes more than halfway into the previous red candle. In a downtrend, we look for bearish confirmation patterns. Reference Figure 7. A bearish engulfing pattern, a red candle that completely engulfs the previous green candle. Sellers are taking control. A shooting star. A candle with a small body and a long upper wick. Buyers pushed price up, but sellers pushed it right back down. A dark cloud cover. A red candle that closes more than halfway into the previous green candle. These patterns tell us the pullback has ended and price is about to resume its trend. Wait for the candle to close. Don't enter on the open. Enter when the candle closes, confirming the pattern. Now we put it all together. When all conditions are met, we enter the trade. The entry rules are clear. Reference Figure 8. Trend is identified. Price is above the 50 SMA for buy, below for sell. Pullback to the 50 SMA. Price has touched or come very close to the SMA. Confirmation candle. A bullish or bearish candlestick pattern has closed. Entry. Enter at the close of the confirmation candle or on the open of the next candle. Reference Figure 9. Look at this example. Price is in an uptrend above the 50 SMA. It pulls back to the SMA. Then we see a bullish engulfing candle close. That's our signal. We enter buy at the close of that candle. That's it. No guessing, no emotions. Just follow the rules. Remember, if there's no pullback, there's no trade. If there's no confirmation, there's no trade. If the trend isn't clear, there's no trade. Discipline is what makes this strategy work. Next step, we set our risk management. This is just as important as the entry. Setting your stop loss. Reference Figure 10. For a buy trade, place your stop loss just below the recent swing low. This is the lowest point of the pullback before the bounce. For a sell trade, place your stop loss just above the recent swing high. This is the highest point of the pullback before the drop. The stop loss should be placed beyond the area of the pullback, giving price room to breathe. Reference the table. Buy long, stop loss below the recent swing low. Sell short, stop loss above the recent swing high. Setting your take profit. Reference Figure 11. We target a 1 to 2 risk-reward ratio. This means if your stop loss is 20 pips away, your take profit should be 40 pips away. Calculated this way. Measure the distance from your entry to your stop loss. Multiply that distance by 2. Add that to your entry for buy or subtract for sell. Position sizing. Reference Figure 12. Now we calculate how much to trade. Remember the position sizing formula from earlier. If your account is $10,000 and you risk 1% per trade, that's $100 risk. If your stop loss is 20 pips, you need $5 per pip. In euro to US dollar, that's a volume of 0.50. Position sizing protects your account. Never skip this step. Reference Figure 13. Here's your complete strategy checklist. Use this before every trade. Step 1. Identify the trend. Price above 50 SMA? Buy only. Price below 50 SMA? Sell only. Step 2. Wait for the pullback. Has price touched or come close to the 50 SMA? Is this a legitimate pullback, not a trend reversal? Step 3. Look for confirmation. Bullish engulfing for buy. Bearish engulfing for sell. Wait for candle close. Step 4. Enter the trade. Enter at the close of the confirmation candle. Step 5. Set your stop loss. Just below recent swing low for buy. Just above recent swing high for sell. Step 6. Set your take profit. 2 times your stop loss distance. Minimum 1 to 2 risk-reward ratio. Step 7. Calculate position size. Based on 1% risk. Account size times 1% divided by stop loss pips. Step 8. Execute. Click buy or sell. Print this checklist. Keep it next to your computer. Use it for every single trade until it becomes automatic. Let me walk you through an actual trade from start to finish. Trade setup. Reference Figure 14. Look at this chart. We have euro to US dollar. First, I look at the 50 SMA. Price is clearly above the 50 SMA. We're in an uptrend. Buy only. Then I wait. Price moves up and pulls back toward the SMA. It touches the SMA and starts to bounce slightly. Now I look for confirmation. The next candle is a bullish engulfing candle. It completely engulfs the previous red candle. This is our signal. Trade execution. Reference figure 15. Now I enter. I buy at the close of the bullish engulfing candle. I set my stop loss just below the recent swing low. That's about 20 pips away. I set my take profit at 40 pips away, 2 times my stop loss distance. Then I calculate position size. On a $10,000 account risking 1%, that's $100 risk. With a 20 pip stop, I need $5 per pip. That's 0.50 volume in euro to US dollar. I click buy and the trade is on. Now what happens? Price continues in the direction of the trend, hits my take profit, and I'm out with a 40 pip profit. That's it. Simple, repeatable, profitable. Let me show you the most common mistakes traders make with this strategy, so you can avoid them. Mistake 1. Trading against the 50 SMA. Taking a buy when price is below the 50 SMA, or a sell when price is above it. This is fighting the trend. The reality, you're taking low probability trades that go against the larger market direction. The fix, only trade in the direction of the 50 SMA. No exceptions. Mistake 2. Entering without confirmation. Buying as soon as price touches the SMA, without waiting for a candlestick signal. The reality, price often slices through the SMA without reversing. You get stopped out quickly. The fix, wait for a candlestick confirmation signal. Patience pays. Mistake 3. Setting stop loss too tight. A 10 pip stop loss on euro to US dollar is asking to be stopped out by normal market noise. The reality, normal volatility will hit tight stops, giving you losing trades even when your direction was correct. The fix, place your stop below the recent swing low or above the recent swing high. Give price room to breathe. Mistake 4. Taking 1-to-1 risk to reward trades. Risking 20 pips to make 20 pips. The reality, you need a 50% win rate just to break even with 1-to-1. That's not a winning strategy. The fix, always aim for 1-to-2 risk-reward minimum. With 1-to-2, you only need a 34% win rate to be profitable. Mistake 5. Moving stop loss wider. Widening your stop loss as price approaches it, hoping the trade will turn around. The reality, you're turning a small, controlled loss into a large, uncontrolled loss. The fix, your stop loss is final. Never move it wider. If it gets hit, accept the small loss and move on. Here's your quick reference for the moving average pullback strategy. Step 1. Identify trend. Price above 50 SMA equals uptrend, buy only. Price below 50 SMA equals downtrend, sell only. Step 2. Wait for pullback. Price touches the 50 SMA. Step 3. Look for confirmation. Bullish or bearish engulfing pattern. Wait for the candle to close. Step 4. Enter trade. Enter at the close of the confirmation candle. Step 5. Set stop loss. Below recent swing low for buy. Above recent swing high for sell. Step 6. Set take profit. 2 times your stop loss distance. Remember this, if you follow these rules, you'll have a positive expectancy over time. You will have losing trades, that's part of trading. But the winners will be larger than the losers, and over time, you'll be profitable. Congratulations! You now have your first complete trading strategy. The next step is practice. Take this to your demo account. Trade it for at least 50 trades before considering real money. Learn the nuances. Build your confidence. Remember, discipline beats intelligence every time. A mediocre strategy executed perfectly will outperform a great strategy executed poorly. Good luck and happy trading!